In today's episode, I'm going to talk about how I turned a day trading account with less than $600 into more than $335,000 in 1 year. By the end of the second year, the account was at over $800,000. By the end of the third year, I'd crossed over $1 million. And by the end of the fifth year, the account was over $10 million in verified and audited profits. Today is going to be the first time ever that some of you have seen my third-party independent audit verifying these returns. Now, I don't want to spend this whole episode focusing on the profits and bragging about how much money I've made. Profits are a byproduct of a system and a strategy. In today's episode, I'm going to share with you the process. I'm going to share with you the set of rules that I followed in this small account and how I was able to grow it. We're going to focus especially on those first few weeks, the first month, and the first year, because that's when the pressure was the highest. What you're going to learn is that the hardest part about trading is learning to consistently make just 15 to 20 cents a day. It seems like nothing, but the reality is once you're doing that consistently, scaling up from there, well, it happens a lot faster than you might expect. Now, because this is a class that I'm teaching today, I have some handouts for you. So linked in the description, pinned to the top of the comments, you will find a small account strategy PDF. You can download this and you can follow along with me during this episode as I break down for you the system, the rules, and the strategy that I've used to grow this tiny account. So let's go ahead and dive right in. Now, for those of you who enjoy reading, I'm going to have some recommended reading that I'll give you at the end of this episode so you can continue learning, because I understand that everyone learns in different ways. One of the most, I suppose, challenging parts about trading is that just to get yourself ready for day one, there's a lot of information that you need to know. I would call it the general information about how the stock market works. Now, I personally am a hands-on learner, and I bet many of you are as well. And so what worked really well for me when I was getting started was to actually go ahead and open an account. Now, I should have used a trading simulator, but I used real money because I was naive and I didn't know better. But by opening up that real account and going in and trying to take my first trades, all of a sudden, I began learning a lot of the necessary information that you'll need to know for day one of trading, right? I started to learn about the different types of orders that you can use. I started learning about how the prices are quoted. I learned the difference between the bid and the offer. These are all little bits of general knowledge that you pick up as you're getting into it. Now, you can learn all of this in a book, and certainly that's a great way to learn. And I do have a book that I've written that covers a lot of this, but you can also learn just through the process of actually doing it by getting hands-on. You're going to realize as you get ready to take that first trade that, wait a second, I don't know the difference between these different order types, limit versus market. And you're going to do some basic research and you're going to figure out, okay, this is what these two orders do. Now, one of the things that they often say is that if you love what you do, you won't work a day in your life. In my experience as a trader, because I've enjoyed it so much, it never feels like work to research and learn more or to read books or to watch episodes like this, because it's something that is so fascinating to me. And I think one of the reasons it's fascinating for me and for many other people is that we know if we're able to find success, the rewards can be incredible. Now, as we begin this episode, I want to put out a little bit of a disclaimer. I want you to know that although I am sharing my results with you, I don't want you to assume that my results are typical or that you'll achieve a similar result, whether you learn from me or you trade on your own. What we know is that trading is risky and most people do lose money. I would argue that the reason most people lose money is for one of two reasons. The first reason is because they don't have a strategy. They don't have a system or a set of rules that they're following that dictates the type of stocks to buy, where to get in, where to get out, when to walk away each day, when to stop pushing, and when to double down and lean in. So if you don't have a strategy or a set of rules, it's not going to be much of a surprise if you don't find consistency as a trader. Now, the second reason people lose, they have a system, they have a strategy, but they are unable to maintain the discipline to follow those rules. And this is something that I can really relate to, because as I went through the process of developing the strategy that I'm still trading today, I struggled to maintain the discipline to follow the rules that I laid out for myself. Some of you may have gone through this as well. So in this episode, as I talk about the system, the strategy, and the rules, I'm also going to share with you some tips and tricks to help you be a more disciplined trader. Because ultimately, it is the traders who are the most disciplined who typically find success. If you can't be disciplined as a trader, if you can't follow your rules, you can't expect to succeed. So when I funded my account with less than $600, I was already a profitable trader. I funded the account with the goal of seeing really whether or not it was even possible to day trade with such a small amount of money, because a lot of people said it wasn't possible, you couldn't do it. And you might be one of those traders as well who says there's no way this could be done. So I want to tell you that that's not true. It can be done, but it is very difficult. And it requires knowing a few different ways to trade, because as you may already understand, if you open an account with E-Trade or Ameritrade today, Thinkorswim, they won't let you day trade with a $600 account. So right away, there's a little bit of a barrier to entry to get in, because you have to know about the type of brokers that I was using, which most people don't even know about because they don't advertise here to most traders. So in addition to the link in the description to download my small account strategy PDF, you'll also see a link to international brokers. So when I began this small account challenge with less than $600, I funded an account with an international broker. International brokers don't enforce the PDT rule. And I found this to be incredibly helpful because I knew that I wanted to trade. So let's jump onto the whiteboard here. Now, I'm going to show you these audit results in a moment. But first, let me break down for you how this worked when I funded the first account. So I funded the account here with just under $600. We'll just do 600 just to keep the numbers easy. So just under $600 went in. Now, the broker that I funded the account with allowed what's called leverage. Leverage means you could trade on borrowed money. Now, if you funded an account with Thinkorswim or E-Trade right now today, you would get 4 times leverage. So that means, let's say, for instance, you funded an account with $25,000, you have times 4. That means you have $100,000 of buying power. But you notice I started with $25,000. That's because you need $25,000 minimum to day trade with a U.S. broker-dealer. $25,000 is kind of a steep mark, right? That's a lot of money. So I didn't want to fund an account with that much money. I wanted to prove that you could do it with far less. So I funded an international account with $600. Now, they offer 6 times leverage. So 6 times 6 is $3,600. That's how much money I had available in buying power on day 1. So on day 1, you know what my goal was? My goal was to see if I could make 15 to 20 cents a share. 15 to 20 cents. That's it. Doesn't sound like a lot, but 15 to 20 cents a day can be the difference between, well, losing money and making more than $10 million over the course of 7 years, which is exactly what I've done. So what I did on day 1 was I was looking for a stock, ideally, perfect price range, $3 a share. Approximately $3 a share to $3.60. Why did I choose that price range? Because I knew at that price range, I could buy 1,000 shares. And if I could make 15 to 20 cents, I would make $100 to $200. Well, $150 to $200 if I make 15 cents. $150 to $200. And that was my goal. I wanted to see if I could grow the account by $200 on day 1. Now what I want to do is I want to show you the results of day 1. On day 1, I came up a little bit short. Not surprising, I'd set the goal pretty high. I came out with $125.70. On day 2, I made $187.89, as you can see right here. On day 3, I made $150. On day 4, I made $154. So by the end of the first week, we've got $300, nearly $400, $500, $600 of profit. So now let's look at how the account looks. Now the account has closer to $1,200 in it, right? $1,200 here. Times 6, now I've got $7,000 plus of buying power. $7,200 of buying power. And that meant going into day 5, day 6, day 7, I could now buy a little bit more stock of every trade I took. Now, some people will misunderstand this style of trading as risking $7,000 or whatever it is on every single trade. But that's not the way I manage risk. So maybe what we should do is take a step back and talk about the strategy, the system, and the set of rules that I follow. My interest in the market began in 1998. I was in school and I had a semester dedicated to the stock market. I decided then and there that the stock market was for me, and I wanted to learn everything about it that I possibly could. I wanted to start trading with real money at that time, but I wasn't able to. I was too young. In 2001, I opened my first account with real money, but I didn't find much success because I didn't have a system or a strategy of how to find strong stocks to trade. So I ended up not making any money at that time. But during the Great Recession, this was after the financial crisis of 2007, 2008, the job market was so abysmal, and I was living in rural Vermont, that I couldn't find a good paying job. And so I went back to the idea of being an online trader, trading the markets from the comfort of my own home on my laptop. That sounded pretty good to me. But I spent the next 2 years going through a period of trial and error, trying to figure out a strategy that would work for me. Now, what I want to do is I want to actually show you here my metrics, because I'm going to pull this up. I'm going to clear this out. And we're going to take a step back and look high level at these metrics. When we look at these metrics high level, these are going to tell a story. They're going to paint a picture. What I have right here so far is just over $11 million in net profit. This is net of fees and commissions right here. Okay, so that's the total big number. But where does that number come from? As you see where that number comes from, you're going to begin to recognize that from just this data, you could build out a summary of my strategy. Okay, so let's look at my performance by price and volume. This is where I think you'll see the most. So what you'll see is my performance by price right here is going to show you that I make the most money on stocks priced, well, between 2 and 50 right here. And certainly I make the most in this range right here, which is between 2 and 20. So all of my profit has been categorized here and sorted based on the price of the stock I've traded. And this is where I do the best. Now, what you would also notice if we scroll down a little bit further is that, or actually we'll look over at the instrument side. If we look over here, some of my biggest winners, in fact, are on meme stocks: COS, GameStop, Cone, UNOE, Carve. These were stocks that made incredible moves during 2021. But if we scroll down a little bit further, what you'll notice here is that my performance predominantly is, we're going to switch back to this one here. We're going to stay on this one. My performance is on stocks that are up over 10%. You see how this is performance on stocks up over 10%? And what you'll also notice is that I make the most money when we have high relative volume. So one of the things that I look at very closely in these metrics, and we'll scroll back up here, this shows my performance by relative volume. If you see right here, this is $9 million, over 80% of the profit is on stocks that have 5 times relative volume. So let me help put this into kind of simple terms. I make money when stocks have 5 times higher volume on the day that I'm trading them. And I make money trading stocks that are up 10%. So I'll pose the question to you. Why would a stock be up more than 10% with 5 times higher volume? What's a possible reason? News. The stock has breaking news. So through 2 years plus of trial and error, what I learned was that I found the most consistency trading relatively lower priced stocks when they have breaking news. These breaking news events, and there's all kinds of news catalysts that can move a stock. It could be a pharmaceutical company with FDA announcements, clinical trial results. It could be any company that has great earnings or a new contract. But when you have a low price stock that's trading at $2, $3, $4 a share, and they come out with really good news, those types of stocks can go up 50 to 100% in a single day. And these are the places where I was making hands down the most money. And these stocks on these particular days often are the biggest percentage gainers on all of Wall Street. So out of 10,000 plus stocks on any given day that you could choose, usually the one I'm trading is the one that is the leading percentage gainer out of all of them. Now, finding that stock in real time proved difficult. And I'm going to walk you through the process that I follow to find those stocks. So this right here gives you a good sense that I'm trading primarily a breaking news strategy. The stocks I make the most money on have 25 million shares plus of volume. So I need that volume. I need that high relative volume. Relative volume, by the way, is the measure of today's volume relative to what's normal for this stock. So if it normally trades on only 1 million shares of volume, but today is 25 million, it's got 25 times higher volume today. And obviously there's a catalyst that's bringing that volume in. So let's begin to document what we know about my strategy. Now, for those who have already downloaded the PDF, you'll have this in written form as well. Okay, so what we know is that price, I'm focusing on stocks between 2 and 20. That's where I tend to do the best. We know that we're going to look at percentage of up at least 10% today. And we know we're going to look at relative volume of at least a ratio of 5. So 5 to 1. So it's got to be at least 5 times higher than average. Now, what we know is that typically there has to be a news catalyst, because news is what's going to create the rate of change and the relative volume. The price just happens to be the range where I've found the most success. And I think for a lot of us, us being retail traders, lower price stocks are easier to manage risk on and they're easier to trade. We have smaller accounts. We can't afford to buy $75, $100, $200, $500 a share stocks. We would only be able to buy a few shares of it. So we just naturally make more when we can trade, let's say, 1,000 shares of a $3 stock. 1,000 shares of a $3 stock or 100 shares of a $30 stock, or 10 shares of a $300 stock. It's the same amount of money, but on one of them, you're going to be much more likely to see a 10-15% move and you're going to get a bigger return. And that's always going to be on the lower price side. Now, certainly you could do 10,000 shares of a 30-cent stock, and that's where you could see potentially an even more explosive return. But I actually, in my career, haven't done super well on those really cheap stocks, as we saw from my metrics. Although I, at times, will trade them, under $2 for me is not a very rewarding spot. I tend to do better, as you could see, between 2 and 20. That's really my sweet spot. Now, something that you may not understand in trading is that we have the concept of supply and demand. You may have heard the concept before of supply and demand. When there's a limited level of supply and a lot of demand, prices go up. This is what happened during the housing booms, right? All of a sudden, lots of people want to buy. The mortgage rates are super, super cheap, so everyone wants to buy a home, but there's a limited level of supply. What happens? The price of homes go up very, very quickly. Well, in the stock market, we have a similar experience with supply and demand. The supply is the number of shares available to trade. So when a company does its initial public offering, they sell a fixed number of shares onto the market, and that's the supply. Okay, so it's a fixed number of shares. Now, if all of a sudden that company puts out really great news, people are going to want to buy that stock. They're going to think the stock price is going to go up in value. And since there's a limited level of supply, the increase in demand pushes the price up. So let me show you this on the whiteboard. All right, so I'm going to do one more thing here first. So float, which is the number of shares available to trade, float is the term, we're going to have this under 20 million. I would prefer under 10. This is my preference, but under 20 million is pretty much a hard number. Now, there are some exceptions to that. GameStop, when I traded it, was a higher float, but generally speaking, that's what I'm going to prefer. Okay, so this is going to be a little relationship here between demand and supply and demand. So let's say you've got a float here of 10 million shares, and let's say you have 10 million shares of volume. So if you have 10 million shares available to trade and you have 10 million shares of volume, those seemingly kind of balance each other out, right? You've got an equal amount of demand and supply. Now, on a day like this, if the stock really has good news, the price can still go up, and the price can go up because there are people that are holding that don't want to sell. So there can be still a relationship where the price goes up. But now let's imagine this if there's only 1 million shares of supply. There's only 1 million shares of supply and there's 10 million shares of demand. That's when you see the price move very, very quickly. And so when we talk about something like GameStop, when it began its move, had, I want to say, about 30 million shares available of supply. But it was trading. The amount of volume it was trading was insane. I mean, it was hundreds of millions of shares of volume was pushing this higher. And so essentially, you had such a heavy amount of demand, the stock went parabolic. And that's how it went from $30 a share to 40 to 50 to 60 to 70 to 100, and then to 200, and then to 300, and then to 500. just this massive squeeze. And what effectively happened there was we had what's called a short squeeze. Now, I could spend a lot of time talking about short squeezes, but for right now, we'll stay focused and just say that when I'm looking at my strategy, what I know is that I need a price between 2 and 20. It needs to be up at least 10% on the day. The relative volume should be 5. There should be news. And the float should be less than 20 million shares, although less than 10 million is preferable. And certainly if you have a situation of a float of less than 1 million shares, that can be even stronger, but it's not necessary. If it happens, it's fine. But what we really want to see is a massive imbalance between supply and demand. Now, because we have more than 10,000 stocks in the market that you could trade on any given day, there is almost always a stock on any particular day that has a breaking news catalyst. This breaking news, and it's just to pause on that, what's really interesting is that as a breaking news trader, I'm usually trading different stocks pretty much every day. I'm just trading what has news today. So I'm moving all around the market. Some people have the notion that you should get really good at trading one stock, like Apple or Tesla or something like that. However, what I've learned is that if you try to do that, what you're trying to do is the equivalent of play chess against the computer. Because what you may know is that more than 60% of the volume in the market is actually driven by high-frequency trading algorithms. These are computer programs that institutional traders have developed. They hire MIT, graduates, these PhDs who are incredibly smart. Instead of having them work on, things that are really maybe important, they are put to work figuring out how to create an algorithm and a code to make more money in the stock market. So that's what they do. And as a result, stocks that are very liquid, like Tesla, Nvidia, the S&P 500, they are dominated by these high-frequency trading algorithms that are competing to make money. But if we look at my metrics, you could see, certainly, those aren't the type of stocks that I'm trading. In fact, these are the types of stocks that those high-frequency trading algorithms wouldn't really have that much interest in. And you want to know why? It's because they want predictability. When they have a computer trading for them, they don't want to be trading something that could be going up or down 50% in one day. That's way too much volatility. In fact, a lot of these algorithms are trained to be turned off if the market exceeds a certain variation in percentage change. So these algorithms create a lot of liquidity by buying and selling when stocks are moving in a narrow range, but when they start moving out, those algorithms turn off. And that's when things get exciting. So on a day where Apple or Tesla or one of these big S&P 500 types of companies has big news, then it'll actually more likely on that particular day have less high-frequency trading algorithms and have more individual traders. And that would be a day that you could consider trading it. But for me, I've always focused on this little area, this little niche of the market, which is small cap stocks. Because these small cap stocks, when they have news, that's when we see these big percentage moves. Okay, so my system is to look for these types of stocks every single day. This is what I know I trade. This is what I know that I make money on. But how do I find these in real time? I'm using stock scanners. So I actually hired a development team to build out these stock scanners for me. And these scanners are literally searching the market in real time for stocks that meet the criteria I just broke down for you. So this stock right here, Duo, is up 313%. Price is $1.65. It has 100 million shares of volume, but the float is only 5.85 million shares. The relative volume is 561. So if we go back here, this meets pretty much all of our criteria. It's a little cheaper than maybe I'd like, but other than that, I mean, this thing has relative volume of 500. It's up well over our minimum of 10%. And this is the type of stock that we could get really excited about. The second leading percentage gainer, and this I always sort by the leading gainers. You could sort it by other columns, but I sort it by this. FLJ, 200%. JFBR, up 100%. IPW, up 96%. OPGN, or OGEN, up 43%. CTNT, up 43%. XIN, up 39%. So I could check on any one of these stocks, and I could look at the chart. I could start to get dialed in and ask myself, all right, this thing is moving. So now the next question is, where am I going to buy it? If I was going to break down how to trade as a beginner into 3 steps, this is how I would do it. Step 1 is to learn a strategy. It should be a strategy that other people are trading and is proven profitable. Whether it's my strategy or it's someone else's, it doesn't matter. But just make sure it's a strategy that actually is working for other people. That's step one. Learn that strategy in and out. That'll include how to find those stocks and also your entries and your exits. Step two is to practice trading in a simulated environment. Because if you can't make money in a sim, you have no business trading with real money. Step three is to flip the switch and trade with real money, but start with small size and only increase if you're producing profitability. Now, when it comes to learning a strategy, it's really important that the strategy that you're going to learn is actually profitable. And so I'll take this as an opportunity to show you, and this will be the first time some of you have seen this, my third-party independent audit. This is an independent accountant's report of my trading profits. And so what we have here is when I began the account, the small account challenge, I funded it with $583. This is right here. So I funded it right here with $583. That was on day one, month one. By the end of that month, January, I was up $16,000. February, I was up $60,000. And this is recording every single month. So $335,000 for the first year from a $583 starting balance. I began the next year with $35,000 in the account. I took profit out. I took out $300,000. I finished with $500,000 of profit. Now I'm up over $800,000. Then I go into year three. I cross over $1 million. I go into year four. I make $4.5 million. I go into year five. I make $3.8. I go into year six. I make $800. I go into year seven. I'm up $300. This is a total cumulative profit of $10,719,735, an average monthly return of $127,000 a month, an average monthly percentage return of 64% per month. This is real money. This is an audit. This is an independent accountant's report analyzing each of the brokerage accounts that I had during this period of time. I share this with you because I can. This is real money. My performance speaks for itself. Now, I will say, as always, my results aren't typical. And you shouldn't assume that you'll make this kind of money. And you shouldn't assume just because you learn from me that you'll be a successful trader, because there's no guarantee of that. But what it is important is that you know that if you're going to spend time trying to learn someone's strategy, that's actually profitable. If they don't have at least broker statements on their website, you've got to ask the question of why not? And I think there's only one reasonable answer. Because anyone who's trying to put themselves out there and say that they're profitable is going to put up the proof. And so I like to share this with you so you know beyond a shadow of a doubt that the person you're learning from is credible and qualified. The strategy is being traded by me every single day with real money, rain or shine. No matter what the market is, I'm showing up. Okay. So this is a strategy that I'm trading every single day. And my starting point each day is using this scanner to find the stocks that are moving. Once I've found a stock that's moving, now I have a goal. My goal is to try to capture just 15 to 20 cents per share. That's the starting point. And as I said, one of the things that's frustrating for a lot of traders is that it's just 15 to 20 cents. I'm not asking for a lot, but you can struggle to make that consistently for years and years and years and years. But once you're consistently making 15 to 20 cents per share, right, on your trades, let's do the math. Okay, so you're averaging, let's say, 15 cents per share. You're doing that in the simulator with 100 shares. So your winners are $15. Okay, it's not a lot of money, but you're doing that consistently. You're making $15 a day. So you flip the switch, you trade with real money, and you continue making 15 a day. And you say, you know what? I'm going to start increasing. So now you go up to 200 shares. Now you're making 30 a day. Then you go up to 300 shares. You're making 45 a day. You go up to 500 shares, right? And you're making $75 a day. Then eventually you make your way to 1,000 shares. You're making 150 a day. Then you say, you know what? I'm not going to stop here. I'm going to go 2,000 shares. Now you're making 300 a day. You go to 4,000 shares, right? You're making 600 a day. This is how it scales up. Now, I always say that there is a limit to scalability in the market. Some people think, well, geez, if I could do it with 100 shares, I could do it with 100,000 shares. But what you will find is that actually there is a bit of a diminishing return. In fact, if you tried to do it with such big size, you would actually lose money. So there is a sweet spot where you will find that you make the most. And for me, generally, it's on positions between, I would say, 10 and 20,000 shares where I kind of do the best. When I start to go heavier than that, I find that I have to either hold longer to mitigate the fact that I get some slippage on my entries and exits, because there's not always the liquidity to move in and out of the market with this kind of position. So it's not a linear curve. It's not a linear kind of growth as you just increase size. You can't just grow exponentially. But the difference between 100 shares and 1,000 on a liquid stock, there's very little slippage. So this is the area that most beginner traders should be focusing, starting with 100 shares and focusing on just 15 to 20 cents per share. Now, this is especially if you're focusing on the lower price stocks like I am. If you're trading stocks like Tesla and Nvidia, 15 cents isn't going to be enough profit, because on your losers, you're going to be losing 15 cents. So the way I think about trading in terms of risk, if I'm going to take risk, let's say I'm going to risk 100, I want the potential to make 200. So I want to have a 2-to-1 profit to loss ratio. So that means if my profit target is 15 to 20 cents, I don't want to lose more than 7 to 10 cents a share if I can. That's going to be my goal, to try to keep my max loss very tight on a trade. So now we've found the stock that we like. It's going to be the leading percentage gainer, the one that's moving up the most today in the entire market. Okay, the question next is, where do I get in where I can get my 15 cents a share without risking more than, 7 to 10 cents? Okay, so this is going to get into technical analysis. Technical analysis is the universal language of the financial markets. It doesn't matter if you're trading stocks, forex, cryptocurrency. You could be trading any financial instrument. And if you can pull up a candlestick chart like what you're seeing right here, you can do technical analysis. So learning how to read candlestick charts will no doubt be a critical component to being a successful trader. What I will share with you in this episode is the basic form of technical analysis and one of my most preferred entry patterns. This is going to be a multi-candlestick pattern. Now, for those of you watching, they're at the very beginning of your learning curve who haven't learned anything about candlestick charts, I have episodes that are dedicated specifically to this topic, where the full episode is just how to read candlestick charts for beginners. So I don't want to repeat everything in that episode here today, but I'll give you a Cliff Notes version, and then we're going to talk about this pattern. So a candlestick chart is a chart that shows us historical price. So when we look at this, just go like this here, this is showing us the history of this stock. This is a daily chart, which means each one of these candles represents one day of time. And we could see very clearly by looking at this chart that this is a stock that's been selling off for quite a while. So what the chart does is it gives us context. It helps us understand the current price relative to where it's been. Because if all you saw was, oh, this stock is 65 cents, you wouldn't know if that's a good thing or a bad thing. It's a good thing if the stock has always been trading at 4 cents a share, but it's a bad thing if it used to be trading at $10 a share, which this one did. So the stock chart, the historical chart, gives us context. But what we're ultimately trying to do is we're trying to make a prediction about what's going to happen next. So we use a combination of technical analysis, analyzing the historical chart here, with looking at breaking news and watching the trend. So when I'm looking at a candlestick chart, to give you the anatomy, each candlestick communicates 4 pieces of information: the open, the close, the high, and the low. If this is a daily chart, then this candlestick represents one whole day of price action. That means the market opened at this price. It hit a low of this price down here, which we call the bottom of the candle wick. It squeezed up. It hit a high of way up here, and then it closed right there. The only difference between a red candle and a green candle is that the open is at the top and the close is at the bottom, because a red candle is going down in price, right? But the shapes can be more or less the same. So we, as active traders, use the daily chart to help us gain context, but we're primarily, naturally, trading on intraday charts. I'm trading on 5-minute and 1-minute charts. That means each candlestick I'm looking at, if I'm looking at a 5-minute, will represent 5 minutes of time. So generally, this is what happens. A stock comes out with breaking news. So boom, boom, boom. There's the news. Let's say it's 8 a.m., top of the hour. breaking news comes out. So we've got a news alert. Now, how do we know that there's news? Do we search for every breaking news headline of every stock in the entire market? No, that would be impossible. And even if we could do that, we wouldn't know the context of whether or not that news is good or bad without looking at the chart to see if the price is going up or down. You would have to know the company very, very well to know just by reading the headline what the stock is going to do. So we don't try to read every single headline that comes out. That would be a waste of energy. Instead, what we do is we use these stock scanners right here to search the market for stocks that are making new highs. These stocks right here are hitting my high of day momentum scanner. So as they make a new high, each time it hits a new high of day, as it's pushing higher, it hits a new high of day, a new high of day, a new high of day, it triggers an alert. As long as it meets the criteria that we already talked about from the perspective of price, volume, percentage change, and float. So now we see a stock hitting the scanner and firing alerts. These are audio alerts, so even if I was outside or across the room, I'm going to hear that there's a stock moving up on my scanner. So now I'm going to come over and I'm going to look at it. What I know is that there's a psychology that happens in the market among traders when a stock begins moving. What happens initially is the stock pops up, people see it, and they're like, oh my gosh, something is moving. I want to get a piece of the action. Now, you will have some traders who were in the stock already before the news came out. So as soon as it pops up, they're like, holy smokes, I'm going to sell and take profit. So we have the initial squeeze up, and then we have a little bit of a pullback. Now, if there's a lot of people that want to sell, that's going to create a lot of supply. They're going to sell, and the price could go all the way back down. So this is the moment where supply and demand comes into play. So at this moment right here, we start to see a little bit of a pullback. We see some selling. Some people are taking profit, which is natural and to be expected. We dip down a little bit more. And now at this point, there's a couple questions that I'm going to ask. How much selling is occurring on these candles? The way I will know how much selling is occurring is by checking the volume bars on these candles. So let me show you an example. If you look on this chart right here, you'll see that we had the initial spike up right here. We got this move where a stock actually went from $5 to $6 to $7 to $8 to $9 to $10, almost to $11 a share, which was a really incredible move, up well over 100% just in 5 minutes. But then it started to pull back. And what I look at is the amount of volume on the selling candles. So each candlestick is driven by a certain number of shares. And these shares are tracked down here as volume. So what I saw here was there was more selling volume than buying volume. And when there's more selling volume than buying volume, usually what that means is the stock is going to keep declining. I'll show you another example right here. This is a great example where you've got very light volume buying and then high volume selling. 1, 2, 3, 4, 5 red candles. So when I pull up the chart, I like to see those big green candles, but then the next thing I'm asking is, when we have the pullback, are those candles huge red candles or are they small? So in this case, what we would want to see is that when we have the first move up, let's just say, for example, we have high volume green candles, and then we have lighter volume red candles. That's what we would want to see. If I saw that these were way up here, I would completely change my bias on this potential trade. I would say there's too much selling. This is not going to work. So one of the first things I check is the amount of volume that's occurring on the pullback candles. Then what I'm watching is we had this move up, we had a little bit of a pullback. If this is a light volume pullback, that tells me it's just a little bit of profit taking. And so now I'm thinking people are still liking this. The stock is still holding up. And what I want to do is I want to jump on the next wave up. So how do I know when the next wave up is going to begin? What I look at is the first candle that makes a step up. You have a step down, a step down, a step down. And this right here is making a step up. Another step up. A third step up. A fourth step up. Now, you don't want to buy way up here. This is too extended. I want to get in at the first step up. So that means my entry is going to be this candle right here. And I'm going to be buying that candle the moment it breaks the high of this red candle. So let's say the high there was $7. The moment it breaks over 7, that's where I'm a buyer. My max loss on this trade is the low of this candle. So now based on this, because I know my max loss is the low of this candle. And the reason I know that is because if this turned around and went like this, the pattern would be broken. Okay, so no reason to keep holding if it comes back down to those levels. So let's say this is 680. The low of that candle is 680. Then you're going to say, well, wait a second. Shoot, that's 20 cents a share. You're right. Okay, so now we have to think, if I'm going to risk 20 cents, I need the potential to make 40 cents. The 2-to-1 ratio is the same. Whether it's 5 cents or 15 cents, it's still the ratio. So then we look at the chart, and what if we see that the high up here, which would be our first profit target, to retest a high a day, was at $7.65. Then what we would know is we've got room from 7 to 7.65. That's 65 cents. That covers our profit potential. Now we've got 2-to-1. So I could take this trade. Now maybe on day one, I can't take it with 1,000 shares because a 20-cent stop is $200. I don't want to risk that much money. So maybe on this one, I buy just 500 shares and I risk $100. I risk $100 on this trade. Max loss is 680. Now, if this stock is in fact the number one leading percentage gainer on the day, if it is obvious, if other people see it, if volume is coming in, it's going to get good follow through. That's typically how it works. So now I'm watching that first candle make a new high, and I'm looking for that squeeze back to the high a day. And up here, as it starts moving up, I can take a little profit off the table here. I could sell 250 shares. I could sell another 100 shares up here. I could sell another 100 shares up here. And then I wouldn't sell the rest until the first candle steps down. So holding until we have that first step down. Now, I don't like to hold the full position until we have a step down. I like to pay myself and take some profit off the table. But the last position I'd like to hold, if I can, until we have that first step down up here. This is one of my favorite patterns. Now, this is just one pattern. I have dozens of different technical setups that I will trade. And these are all part of the universal language of the financial markets. What's more important than ultimately the perfect pattern is making sure I'm trading the right stock. The right stock is one that meets all of my criteria and is super, super obvious. There are times where there'll be a stock that meets all my criteria, but there'll be another stock that is more obvious in the market. Maybe it is a stock at 15 or 20 cents that is up 700%. So it's the leading percentage gainer. More people are going to focus on it, but I don't like it as much because it's too cheap. Or maybe the leader is one that's too expensive, or maybe the float is too high. So the best days for me are the days when the most obvious stock is also one that meets my parameters for being the type that I would make the most money on. That's not going to happen every single day, but on the days when it does happen, that's when I can do really well. So this pullback pattern is just one of many different patterns that I would apply. Essentially, when I'm watching chart patterns forming, I'm happy to trade whatever I see. Now, I have learned over the years a number of different patterns that work really well. What we are doing as traders, in a lot of ways, is we are attempting to predict the future. And the way we do that is by visualizing patterns. So this right here, when we see this much of the pattern, we're seeing only the beginning of it. We see the first two candles, the pullback, and we now have to visualize what's going to happen next. So how do we make that visualization? This is really pattern recognition. We've seen this pattern play out again and again and again. We print out the charts. Those of you who have already downloaded and printed out my small account strategy PDF, you have that. You can print out charts just like this, put them around your desk. And then when you start to see in real time a stock that looks very similar to this chart that you've printed out, you're going to say to yourself, now wait a second. We've got 1, 2, 3, 4, 5, 6 green candles in a row. We've got a light volume pullback right here. Now we've got the first candle making a new high. This is where I should buy. And I should take a little profit. It goes through the high, a little more profit. And then the first candle that dips down, steps down, I'll take off the rest. And right there, you've got a trade from $6 up to $8 a share. That's a 20% intraday return. And you do it, in this case, in about 4 minutes. That is fantastic. That's what you like to see. There's another example. You're seeing that move up, a little dip, and then a push higher. This is the pattern that I'm trading pretty much every single day. But again, it doesn't have to be that specific pattern. There's a number of different patterns that I'm happy to trade. We've got variations of this pattern. Sometimes, just for instance, we'll come up to the high here, and then, so we'll have a green candle, and then we'll pull back one more time. All right, so sometimes that'll happen. We call that an ABCD pattern. So then we come up for the second attempt. So sometimes it'll do that. And these are all fine. I'm happy to trade this breakout here and get back out and then get back in right here as it comes up for the second attempt. As a trader, it's more important that you're trading the right stock every day than trading the picture perfect pattern. You will learn more patterns as you gain more experience. Now, some of you are at the very beginning of your learning curve and you're experiencing poor accuracy in your trading. You maybe only right 30% of the time, 40% of the time. And if you're in that situation, I want to speak directly to you because there's something that I can share with you. One of the things that you want to think about when it comes to profitability are that there are three core components. You have your accuracy, you have your profit loss ratio, and then you have your consistency. And the most important of the three is your accuracy. Here's the good news. Accuracy gets better with experience. Any beginner trader is going to have poor accuracy. You don't have a lot of educated intuition. You don't have a lot of experience. You don't have a lot of time sitting in this chair watching these charts forming. I've got more than a decade of this experience. So I've seen more charts than I could possibly list. This is something that can be a benefit for you. By being part of a trading community, like my community, if you choose, you get to piggyback off of all of the knowledge that I've picked up. So what I will also do is in the description, I'll put a link to a 2-week trial at Warrior Trading, where you can have 2 weeks. It's a 2-week trial, and you can use my scanners, you can use my charts, you can listen to my broadcasts, you can watch some more of my classes to begin to pick up on what it's like to be in a community of traders who are doing this every single day. For those of you who have the time and availability to make this happen, then you should definitely do the 2-week trial. For those of you that are still studying, you're working full-time, you're not able to trade full-time yet, keep watching episodes like this, keep studying, keep learning. The more you can immerse yourself in this environment, the faster you will pick things up. So now after watching this episode, you don't have to be the trader who's trading without a strategy. You could start trading a strategy that I'm trading every single day. You could practice it in a simulator, but you still run the risk of being the trader who is unable to have the discipline to follow the rules. So how do we create and cultivate more discipline in our life? I will tell you that discipline is a muscle that you can strengthen with exercise and practice. Things that are going to force you to be disciplined in your life can include an exercise regimen and daily meditation. I do both in my life, and both of these help me strengthen that muscle. Because this is the thing with trading. There are going to be moments where all of a sudden you have the big emotions that come with experiencing loss, the frustration, the disappointment, and your gut instinct is to try to recoup losses quickly and to break your rules. And when you start breaking your rules, well, there's no sense in having them if you're going to break them. The system only works when a trader has the discipline to follow the rules. Now, of course, you need aptitude. There are some natural aptitudes that are going to make it much more likely that you'll succeed than not. But ultimately, if you're not able to be disciplined, regardless of aptitude, you're not going to get anywhere. Now, when it comes to recommended reading, there's a couple books that I would encourage you to check out. This book right here is by Gary Dayton. It's called Trade Mindfully. And this is all about the psychology of trading. This is a trading psychology book. So for those of you that struggle with psychology, this is a must read. For those of you that want to learn a little bit more about candlesticks, this is a good book. It's a little expensive. And honestly, if you watch my video on how to read candlesticks for beginners, you'll find it actually more helpful than this book. But for those that like books, this would be a fine one. Of course, you could check out my book, How to Day Trade the Plain Truth. And I encourage you to check out this book here, Quit, by Annie Duke. This talks about the power of knowing when to walk away. The best traders are the traders who learn to roll with the punches, to take their losses and walk away. Because this is trading. You're going to be red. You're going to have losses. So you better get used to it and you better get good at it. Becoming really good at losing is an important skill. And learning when to walk away sooner is always better. So this is something that she teaches in this book. Learn to walk away before you have a close call. Now, if you found this episode helpful, I hope you hit that thumbs up. I hope you subscribe to the channel, and I'm looking forward to seeing you during the 2-week trial. I hope you printed out the PDF, and I hope you're getting a lot of value out of this channel and episodes just like it. So thanks as always for tuning in, and I'll remind you, as always, trading is risky, so take it slow, manage your risk, and I'll see you back here for the next episode real soon.